Hi, my name is Ewan and I work for Able. So today we're going to be discussing supply and demand. It's just going to be a really basic rundown and breakdown of the principle and definition of supply and demand. I don't really want to overwhelm you with information like how to use indicators, like the divergence matrix, etc. But this is just condensed information that you do need to know and is applicable for economics as a whole. It's a really fundamental process and principle, and it will really help if you know it along the way. So, what is supply and demand? Simply, supply is the quantity of goods or services that producers are willing and able to sell at various prices over a given period, and demand is the quantity of goods or services that consumers are willing and able to purchase at various prices of a given period. So, what does this mean? How does supply and demand affect price? So supply and demand is fundamental and pricing anything at all in all lines of business, trading, economics is fundamental, right? Got to supply the demand. So the chart we're looking at here, the equilibrium price for starters is the intersection of the supply line, which is red, and the demand line, which is blue. And that's the market price where the quantity of goods supplied is equal to the quantity of goods demanded. So Q stands for and symbolizes the quantity of the good or service being supplied to the market, and P represents the price which is being paid for it. So if supply exceeds demand, meaning there's more supply than demand, price will go down. So an example of this could be old mobile phones, right? So the supply of them is huge because everyone keeps getting old phones. We all have them, right? So, but the demand isn't very high. No one wants new phones, but we all have them. So as a result, the price of old phones goes down. Similarly, if demand exceeds supply, meaning there's a higher demand than supply available, price will rise. So this translates to real life too. So for example, Prime Energy drink, the supply was limited and loads of kids wanted it, so the price rose and people wanted it and got it. It's the same for like diamonds and other rare things in life. So let's see changes. So supply and demand changes visualized. So here on the left, we can see a rise in supply. So that's shown from S0 to S1 where the supply line's gone out. So this, as a result, has changed our new equilibrium price from E0 to E1 because this is the new intersection of the line. We can see previously Q0 amount was being supplied to the market and people were willing and able to buy at a price of P0. But now the supply has increased and demand hasn't changed at all. So there's a larger quantity being supplied to the market at Q1, and because of the larger quantity but no change in demand, the price has dropped from P0 to P1 because the good is more readily available. So on the right, we can see a fall in demand from D0 to D1, which has pushed our equilibrium price from E0 to E1. So before Q0 amount was being supplied to the market and people were willing or able to pay a price of P0. But demand has fallen, not as many people want it, but there's the same amount of supply. So people aren't willing to pay the same amount and the quantity supplied to the market has therefore gone down to match the demand, right? Because people don't want to overstock and all of that stuff. So, supply and demand versus buyers and sellers. Supply and demand, buyers and sellers. So, supply and demand is more passive and it's the intent to do something. And that's shown in the market and trading through limit orders. So, we wait for price to get to a certain level and that will trigger our limit order to buy and sell. That creates supply and demand zones, which we'll get into later, and which is why it's so important to understand the principle of supply and demand. On the other hand, sellers and buyers, which is different and not the same thing as supply and demand, are more active in the market. They're aggressive market participants, and they take part in the market, so to speak, with market orders, so market executions. They buy and sell, and that forces the price to actually move. So that brings us on to our next point of comparison, which is supply and demand itself doesn't move the price, whereas sellers and buyers do. So you can't move the price for a limit order. You can only move the price through actioning a market order. For example, a big whale may have a loads and loads of sell orders at a certain price to get rid of his shares, but that itself doesn't move the market. It only stops price from getting there. So when price does drift up there naturally itself, his limit orders will make it go back down. And that's only because it's executed in the market as a buyer and seller. So there can't be a buyer and seller, a buyer without a seller, there has to be a counterparty in trading. So if you want to place a buy order, there has to be someone there on the other end with a sell order. So one will be passive and one will be active, hence the supply and demand and sellers and buyers being different. So order books, this is what you're going to see on your broker, your prop firm kind of side. And this is just to explain what that means. So bids are below, they're buy orders and they're usually green. And asks, their sell orders are above and they're usually red. So we can see the price, this is P on the chart, which people are willing to pay. This is the sell order. So people are willing to sell at this price level, this price level, this price level, and they're willing to sell this much at this price level. The same with buys, they're willing to buy this much at this when price gets to this level. So ask, a sell order specifying the size and price, bid, a buy order specifying size and price. Simple stuff, not too much. So currently price is between the best ask price and the best bid price, between these two price levels. So for price to move, sellers must consume the market size of the best bid order, or buyers must consume / buy the market size of the best ask order. So basically, someone needs to match these orders for price to move on to the next level, whether it be up or down. And these orders constantly update every second and constantly change as price does. So lack of supply and demand can force price changes. So what do we mean by this? We have another chart here. We can see a reduction in supply from S to S1. And as a result, we can see the equilibrium has moved up and there's a higher price in the market at P1 due to a reduced supply at Q1. So a real world example of this would be Saudi Arabia cutting all oil production. As a result, oil prices are going to spike through the roof, right? But as we can see here, no one's fulfilling the orders to make that spike possible on our chart. So the reason for that is a fundamental part of trading, which is a reduction in supply. And this has forced the price movement up due to a lack of supply, not because orders were being filled. So as a result, a supply reduction results in a price rise, and similarly, it translates over to demand as well, and a demand reduction would result in a price fall. All these kind of principles and concepts are very simple, and they work vice versa for both supply and demand and for both reductions and increases. So thank you guys for watching. If you guys do have any problems, questions, or want more information, don't hesitate to get in touch. The best way to do that is probably through the Telegram. Just message an admin and we'll get back to you as soon as we can. So thanks and bye.